Hello, it's me again. Let's do chapter 3. Chapter 3 is significantly shorter than chapter 2. I just looked and I think that the chapter 2 video is around an hour. I expect chapter 3 to be less. Next week, you'll only do chapter 4, so that's a bonus. Let me share my screen. Okay, so we are going to go through chapter 3's lecture now. So you'll want to go ahead and pull up these notes and print them and or have them ready to fill in. So the chapter 3, we're going to focus on journal entries that involve the income statement. So not just the balance sheet. So last chapter's journal entries were all us buying supplies or buying equipment, getting loans, or getting money from owners. That's basically the only thing that happened in chapter 2. We got money from owners, we got loans, and then we bought equipment and supplies and stuff. But that's all we really learned how to do. But we learned the rules of debits and credits, so it was super important. Now we're going to use those rules and apply them to revenues and expenses. So this chapter focuses on the income statement. And what we're going to do is we're going to go through and we're going to learn journal entries for those. So I was just going to put like this chapter focuses on operating activities, but then when I went to put like everything else, I was like, I should probably put what the other items are. So this is just copied and pasted from your chapter 2 notes. Remember, investing is investing in yourself or others. Financing is owners and loans. So this chapter is going to focus on getting money from customers and paying your employees and stuff. So just a review, I want you to think about the journal and the ledger. And so the journal is where we do journal entries. And so let me pull up your chapter 2 homework for just a second. So the journal is this, where we debit, indent, credit. And then the T accounts is the ledger. And that's where we see balances in accounts. Okay. So a business owner's decided to buy a piece of equipment costing $1,500. He wants to know whether the business has enough money to pay for the equipment. So the question is, does that go in the journal, or would we look in the journal, or would we look in the ledger? So the answer is ledger. Let me go ahead and get rid of this in a minute. And the reason why the answer is ledger is we would go to the cash T account and we would see what the balance in that account was. If we looked at the journal entries, we would see a bunch of receiving cash and paying cash, but we would not have any idea what the balance is. So answer for this one, ledger. Next one, it says the company checkbook shows that the $750 check was written on March 28th. The owner wants to know why that check was written. Okay, so if we looked in the ledger, we would just see the amount 750, but we wouldn't know why. So you would need to go look at the journal entry and you would go find one that was for $750. And if it was this one, then you'd look at it and be like, okay, I paid cash $750. What did I debit? Did I debit supplies or equipment, or what was it? Okay, so the answer for this one would be journal. Next one, a personnel manager wants to know the total she spent on wages. So that would be the ledger. She would go look at the wage T account and go see how much money was in there. And the last one says the marketing manager of a company wants to know the cost of a special full page ad in the Wall Street Journal during the first week of December. And then we frequently advertise. So we can't go look in the advertising T account because it's going to have a bunch of numbers in there. We won't know which one is the Wall Street Journal. If I'm going to be real honest, what we would do is we would just go look at our receipts and find the one for Wall Street Journal. But the better answer here is the journal. And so what we would do is we would go to our journal entries. We would go look at all of them. And we would go to ones dated the first week of December and then look for one that was advertising expense. So, and that's how we would find it. Okay. So next concept is to talk to you a little bit about periodicity. Periodicity is the concept of breaking your business into periods. So when we do an income statement, it's for the month or for the year or for the week or for the quarter. And so breaking a business into periods allows us to compare one period to another period to see if we're doing better or how we're doing. And so the income statement is broken into periods. And we saw that in chapter 1 when we looked at like an income statement for the month or a statement of retained earnings for the month. Okay, the next concept I want to talk about is the difference between the cash basis and the accrual basis. And the word is accrual. And when I'm teaching this class in person, I make the students say it out loud. And so why don't you guys say it out loud too? So the word is accrual, and you can say it. I can't hear you, but I believe that you're saying it with me. The word is accrual. And accrual is a weird word. And the reason why I make you say it is when I took this class when I was like 18, I remember the teacher would always say that word, but I couldn't figure out what he was saying. And I was like, accrual? Like, what is that? And then he'd ask questions and the answer was accrual, but I didn't know how to say it. And so accrual is a basis of accounting. So let's do cash basis first. Cash basis reports revenue when cash is received and expenses when cash is paid. So everything is just based on receiving cash and paying cash, which is fine. It's one way to keep track of your accounting records, but it isn't actually GAAP. Generally accepted accounting principles does not let you use the cash basis. And the reason why you can't use the cash basis is because the cash basis of accounting allows you to manipulate your own income statements and stuff. So if you use the cash basis, you decide when something is revenue, when you receive the money, and you decide when something is an expense, because you decide when you pay your bills. So if a business wanted to look really good, let's say they're trying to get a loan. They want to go to the bank and they want to get a loan and they want to look really good. So if they want to look really good, one of the things they could do is they could not pay their bills, because using the cash basis, if you don't pay your bills, then you don't have any expenses. And if you don't have any expenses, then your net income, your revenue minus your expenses would look great. And so if you do that, then the bank would be like, oh, this is a great business. And then they would loan you money. But does the bank want to loan you money if you don't pay your bills? And I'd answer that no. They do not want to pay. They don't want to loan you money if you don't pay your bills. So what we have to use is something called the accrual basis of accounting. And that's why we have to talk about that. Okay. So the accrual basis of accounting reports revenues when they are earned and expenses when they are incurred. And what that means is when you earn the revenue, it is revenue. That's when you record it as revenue. And expenses are not going to be recorded or will be recorded even if you don't pay them. And so when you incur them, when it happened. So if you get your telephone bill, that's an expense. It doesn't matter if you paid it or you didn't pay it, it's still your expense and it belongs on your income statement as an expense. So incurred, that word scares my accounting majors. My accounting majors even are like, incurred, I don't know what that means. Like, it just means it happened. It means that you got a bill in the mail and you're like, yeah, that's my bill. It's incurred, it's happened. So we have to use the accrual basis of accounting. So according to GAAP, the accrual basis is the only acceptable method for external reporting of income. So if you are publicly traded, you have to use the accrual basis of accounting. So you are still allowed to use the cash basis if you aren't publicly traded. And we use the cash basis for a lot of tax stuff. But so we have to kind of talk about both, but the accrual basis is what we're going to focus on. All right. A couple more GAAP rules, and then we'll move on to doing some transactions. The revenue recognition principle just talks about when something is revenue, and it's based on when you earn it. But usually, like at accounting, timing is an issue for us often, because sometimes you're going to make a sale to a customer, but you're not going to receive the money that day. You're going to receive it later. And that's called accounts receivable. And that's something that we'll see regularly. And sometimes you are going to get a bill, but you're going to pay it later. And so then the question is, what year are we going to put that bill in? Are we going to put it in 2021, 2022? If you get the bill, but you haven't paid it yet? You know, so the accrual basis of accounting and the revenue recognition principle basically say that you record it when you earn it, whenever you earn it. Okay. So here's a separate issue that's kind of weird. And so I'm going to talk about the lawyer example so that you can remember this. Okay. So sometimes you receive money before you earn it. Okay, so sometimes you're going to receive money before you earn it. And so the best example of that, or one example of that, is let's pretend that we're lawyers. Okay, so we own a law firm and we defend clients who come to us. So we're a criminal defense attorney. We are the bull. We are Devon James. We are Brad Postotnik is the bull. We are Brad Postotnik, or we're Devon James, or we're the Bryans. Okay, so all the different accident recovery lawyers on TV. So people come to us and they want us, and they're not criminal defense attorneys, those are accident lawyers. Anyway, okay, we're a lawyer. Okay, so a client comes to us and they're like, I need you to defend me in court. And then I'm like, all right, what happened? And they're like, I did this bad thing. I got a DUI. We say, I got a DUI and I need you to defend me in court. And so when we talk to the client, one of the things that we're going to ask for is what's called a retainer. A retainer is when we ask them to put some money down up front. So to retain us as a lawyer, we're going to ask them for some money right away. So before the client leaves our office, we're like, yes, we will defend you in court. We want $5,000 up front. Okay. 5,000 seems like a lot, but whatever. And so we want $5,000 up front. So we get 5,000 in cash. We are the lawyers and we receive 5,000 in cash. We have a transaction because we have money in our hands and we need to record it. So we need to do a debit indent credit. We need to do a journal entry. Okay. And I know that I received cash, so I know I'm going to debit cash. But the question is, then what? And so is it revenue? I got it from a customer, so it feels like revenue, but I have not done anything yet. I have not earned it. I need to defend this person in court before I earn the money, or I need to do research or whatever I need to do to earn it. So when you receive money from a customer before you provide the service, remember the lawyer example, that is going to be called unearned revenue. Now, unearned revenue. Now, unearned revenue is the only liability that doesn't have payable in it. We owe something to the customer. I owe something to that customer that came in that just gave me 5,000 in cash. I have to defend them in court, or I need to give them their $5,000 back, but I owe them $5,000 worth of services. So unearned revenue is recorded as a liability on the balance sheet. So unearned revenue will be recorded as a liability on the balance sheet. It is not revenue. Unearned revenue is not revenue. So on the next exam, it might say, what kind of account is unearned revenue? And then you're going to be like, well, it goes on the income statement. It's revenue. It's not. It goes on the balance sheet and it's a liability because you have not earned it yet. Revenue cannot be revenue until you earn it. Okay. So the matching principle, is this blank? The matching principle requires that you match revenues and expenses in the same period. It's part of the revenue recognition principle and the accrual basis of accounting. All these things are related. And so the matching principle says that in the period that you record the revenue, when you record the revenue on the income statement, you need to put your expenses on there too. So what we're going to do is we are going to practice that idea. So this just kind of explains some of the other things, like when you pay cash before you or like as you earn it as revenue, or if you whatever. So it's just words. So what we're going to do now is I want you to take a minute and I want you to read through this scenario and I want you to try to compute the profit on this job. So during May, Artesian Stone and Brick laid a stone patio for Louise McCowan. She's one of our customers, for a fee of $1,200. The employees of Artesian worked on this job only for 1 full week. The expenses for the job are as follows. She spent the company spent $400 on decorative stones. These stones were purchased on account and we will pay for them in June. This is May. We bought 2 $10 bags of cement. They were purchased and paid for back in April. And we paid our assistants $200 and we paid that at the end of the week. Now, by the way, we can't pay our people, our customer, or our employees $200 a week. There's no way they're going to work for us, but whatever. Okay. We also spend $600 per month on rent, utilities, and insurance. And we're going to assume there's 4 weeks in the month. This is the only job we worked on. So what I'm asking you to compute here is the profitability on this job. Like, how much profit did we make on it? So we know that there's some revenue for the job, and then there's a bunch of expenses related to the job. This is our only job for the month, so we're going to have to allocate this $600 to this job. And I want to know what your profits look like. So I want you to hit pause, and I want you to jot down some numbers and see if you can figure out the profit on this job. Hit pause. Did you hit pause? Okay, let's go through the solution. So I got an answer of, I think it was $430. And you don't have to write it exactly like this, but the revenue is $1,200. One thing to keep in mind is it doesn't matter when we paid for things, because if it matches, if it's for this job, then it's an expense for this job. So the stones were $400. We have the $10 bag of cement, 2 of those, the wages for the employees. And then I just took the office expenses and I divided them by 4 weeks in the month. And so the total expenses were $770, $1,200 minus $770 is $430. So, okay, so that's just an example of the matching principle. So here I have a homework helper. I had one of these in chapter 2 also, just to give you a list of different names of things on the income statement. You can call your revenue whatever you want. I like to call mine revenue because I'm basic. Okay, you can call it sales, you can call it fees earned, you can call it interest revenue, service revenue, rent revenue, construction revenue, professional fees, whatever you want. And then here's a list of different expenses. They all end in expense except for COGS. Cost of goods sold is the cost of the item you're selling. And I think we talked about that way back in chapter 1 a little bit. So the next thing is just a review of the picture that we actually took, the thing we drew in chapter 2. So I went ahead and just put it directly into your notes now, all filled in pretty. And what we're going to look at, I don't know why that's highlighted. Sorry about that. It's just a picture. And so what we're going to look at is, I'm going to fix that. Well, again, it's okay. Not right now. So ADE have debits, and then last in chapter 2, we only looked at these 3 T accounts, just assets, liabilities, and common stock. And now we're going to look at revenues and expenses. We're only going to add these 2 accounts to the journal entries we're doing. We're going to add these 2 in. We are not going to do any journal entries with retained earnings and dividends till chapter 4. Again, next week is chapter 4, and it's only chapter 4, so it'll be an easier week. Okay, so a review of revenues and expenses. Remember what they are. Revenues are the amounts you're bringing in from providing goods and services, and expenses are those costs involved to get the revenue. So now what we're going to do is we are going to do the journal entries. And so just like last time, I wish I would have put debit and credit above this column, and maybe I'll fix it on the notes before I post them for you guys. But at the bottom of page 4, I'm going to do my first journal entry, and then I'm going to do a bunch of them on page 5. Page 6 has the T accounts we're going to use. And I want you to take a look at page 6 before we start. So page 6 has all of the different T accounts that we're going to use. And it's more than what we had in chapter 2. One of the things I guess we need to start with is I need to know what the beginning balances are, but I guess I'll come back to that later. But I want you to see this page because these are the accounts that we can use. In chapter 2, all we had was cash, supplies, and equipment. I kind of lumped property, plant, equipment together, PPE, but all we had was 3 assets: cash, supplies, and equipment. And then we had accounts payable and notes payable. And then we had common stock and retained earnings. But now look, we have a bunch more accounts. And so as we move forward in future chapters, we will grow and this will get bigger. I added a new liability. I put it in the liabilities column called unearned revenue. I added a bunch of new assets. Prepaid rent we saw in chapter 1, accounts receivable we saw in chapter 1. And then I have my red ones, my revenues and expenses, and I didn't give you dividends because we don't need it yet. So now we have more accounts to choose from. So this is basically your chart of accounts as far as accounts that you can use. So let's go to transaction A. And it says provide website design services for $40,000. Okay, so I'm guessing I'm receiving cash here because it doesn't say on account. Transaction B is going to say on account, but it looks like I'm receiving cash. for providing website design services. So when I provide a service to a customer, it will be revenue, and I'm going to receive cash. So then I have to figure out which account gets debited and which account gets credited. So now I'm going to I'm going to go ahead and open up our T account rules. Okay, so they're still there. And then I'm going to get rid of this one. Okay, so looking at our T account rules, we are receiving cash and it's revenue. So cash is an asset. The asset is going up. So I will debit cash. So I'm going to go up here and I'm going to receive cash, 40,000. Look at you while I do it. I look at my screen and I'm like, did you see it? Okay. And that will be revenue. Okay. I should make it bigger so you guys can see good. Okay. So this is the journal entry. Journal entries have a debit and a credit. I indent my credit. It's very important. And so I received cash and the revenue is earned. And so I'm putting it in revenue. ADE have debit balances. So assets, dividends, and expenses have debit balances. But revenue is going to have a credit balance. We will only be crediting revenue in this chapter because revenue will only go up. We're not going to reduce our revenue. We're not going to have any returns or anything like that in this chapter. So all the time, the revenue will just be going up. Okay. So transaction B also says provide website design services for 20,000, but instead of receiving the money now, we are going to receive the money later. So I'm using that same language I used in chapter 1 to make sure we understand that when you receive money now, it's cash, but if we receive it later, it's accounts receivable. So for this transaction, we are going to receive the money later, but it is revenue. It is revenue. So as far as the two accounts we're going to use, it's going to be accounts receivable and revenue. Last time it was cash and revenue, and we did cash first because we like cash and we were receiving cash. But we're also, in this case, this is an asset and the asset is going up. We do have revenue. So when we look at our two accounts, our revenue account needs to go up. So we need to credit revenue. So we will debit accounts receivable. So I want you to notice the difference between transaction A and B. They are exactly the same, except for this one, I received the money now, and this one, I'm going to receive the money later. Okay, on transaction C, it looks like we're going to collect 18,000 from Acme. Acme is these people. We sent them a bill in the mail for 20. They're only giving us 18. We're probably going to pick up the phone and be like, what up? Why did you only give me 18? But we are going to record that we are collecting 18. So we are going to get 18,000 in cash. So we are receiving 18,000. And so as far as the credit goes, I know it's 18,000 because remember that debits and credits always have to equal because we have to keep our accounting equation in balance. But as far as what the credit is, students want to credit revenue. So students often credit revenue in this particular transaction, but you already recorded the revenue up here. You can't record the same revenue twice. That's not allowed. So what we're doing here is we're receiving the money that we were waiting to receive. So what we need to credit is accounts receivable. I before E except after C. Yeah, okay. So we are going to go ahead and credit accounts receivable. And the reason why is because we are receiving the money that we were waiting to receive. If we look at the balance in accounts receivable right now, like when we post eventually, we'll see that the balance is 2. We're still waiting to receive another 2. And so we'll send them a bill next month for 2,000 and they better pay. All right, I'm starting to get mad. All right, so hopefully we get our other 2,000 here pretty quick. Okay, transaction D, sell a $1,000 gift certificate. All right, so we have a website design business and somebody came in and they're like, I'd like to buy a gift certificate from my friend who just started a business. And so What happens when that happens is they give us $1,000 and we just give them a certificate, right? So if somebody comes into our business and they buy a gift certificate, they give us money and we just give them a piece of paper or a credit card or whatever it is, right? So what happens is we get money. We all agree we get money. And we know we need to credit something, but we're not sure what to credit. So let's go look at our choices. So here are all of our choices. We received money. I knew that. And now I have to figure out what to credit. So it has nothing to do with supplies. It is from customers, but it's not like we've sent them a bill and we're receiving it. It has nothing to do with rent or insurance or equipment or accounts payable. We don't have to pay it later. And so the one we're going to use, students want to use revenue, but we haven't done anything yet. We haven't earned it. So all we've done is handed somebody a card. And so we are going to put it in unearned revenue. So just like the lawyer example, what just happened is we received money before we earned it. So we are going to put it in unearned revenue. So that means we owe someone $1,000 gift. So we are going to have to provide them $1,000 of the service for free now because we've already got the money. All right. So that customer showed up the next day and they're like, I have a card. And we're like, all right, let's do it. So we built them a website. And so they redeem it. So in this transaction, we are not going to receive any money. We already got the money. So what we're going to do is we're now going to record it as revenue because now we've earned it. So we are going to eliminate the unearned revenue because it's no longer unearned. Now it's earned. So what we're going to do is we're going to remove it from unearned revenue, and now it's going to be revenue because now we have earned it. So what we're going to do, oops, sorry about that, is we are going to debit unearned. And we will credit revenue. So now we have earned that revenue. So just like in transactions A and B, when we earned revenue, we've now provided the service and now we have earned it. Okay. So that's the weirdest transaction in this particular chapter. We won't see it a lot until chapter 4, but we will do that transaction quite a bit in chapter 4. Letter F, we're going to pay our employees $16,000. Second line, $16,000. So every transaction, debit, indent, credit, debit, indent, credit. And so one account gets debited, one account gets credited. Cash paid, credit, cash, $16,000. So we paid our employees. So what we have to do is we have to go look at an account that relates to our employees. We have 3 different expenses in this particular business: wage, utilities, and telephone. And so this is obviously us paying our employees. And so we're going to use wage expense. Now, if we look at our T accounts, expenses have debit balances, A, D, E. Expenses have debit balances. That's why their plus is on the debit side. So their plus is on the debit side. And that's because every time we have an expense and then we pay it, we will debit the expense and then credit cash. Okay. So wage expense and cash. The next thing it says is we paid $3,000 insurance for next year in advance. Looks like we're prepaying our insurance, right? So on the second line, we're going to pay our cash. We know the amount is $3,000. And what we're doing is we're paying our insurance, but it's not going to be insurance expense because we haven't incurred the expense yet. We are going to incur it next year. But right now we are prepaying it. Sorry, my blanks are being all weird. I don't know what's going on, but if you scroll, it says prepaid insurance. So we are going to prepay our insurance. And then on letter H, we are going to prepay our rent. Paid $9,000. For rent for the next 6 months in advance. So that will be prepaid rent. Letter I, receive a $250 telephone bill to be paid next month. We are not going to pay it today. We're going to pay it later. If we were going to pay it today, we credit cash, but we are going to pay later. And it's the telephone bill. So I think we have one called telephone expense. I don't know what's happening on the next page. I have no idea what's going on. Figure that out pretty soon because we're almost to that page. Letter J, receive the utility bill to be paid immediately. So we're going to pay the utility bill right now. So we're going to pay our utility bill right now. So that will be utility expense. So it doesn't matter if you're going to pay it now or pay it later. It's your bill and you have to record it as an expense. But if you pay now, you credit cash. And if you pay later, you use accounts payable. Okay. And so now what I'm going to do is I'm going to go like this. And I'm going to just hit like that. Okay. All right. Okay. We're here again. All right. So now we're ready to post. So as we get ready to post here, I need to just record all the transactions in the T accounts. And so posting is a verb. It's the process of transferring it from the journal to the ledger. But the first thing it says is enter your beginning balances from your chapter 2 notes. So we need to go back to our chapter 2 notes. And so you guys have already done chapter 2 because we did it earlier. And so I need to look at my chapter 2 T accounts. They are on page 7. And I need to start with all of my beginning balances. And so cash, last chapter, I had 3,100. So I'm going to go over here and I'm going to put the 3,100 in there. Now I put it on the debit side, and that's because cash is an asset, ADE, debit balances. So cash's beginning balance should be a debit. And that makes sense because it's a debit here, so it's still a debit now. So cash beginning balance, a debit. Supplies is 900. I put BB for beginning balance. And then equipment says 21. Oops. Accounts receivable. So these that have beginning balances of 0, you can put 0 or you can just leave them blank. Okay, so it said equipment was 21,000. So I changed the name of it, but equipment 21,000. Okay. So next account is accounts payable. It's 0, so I'm not going to worry about it. Notes payable is 15. So I'm going to come over here and I'm going to go to notes payable. I'm going to put 15. Now notice I put it on the credit side. Make sure you're putting it on the proper side. Now, so make sure, like when I'm using my words, I'm always careful because I'm like, make sure you put it on the right side. But sometimes it's actually on the left side, right? Because assets are left. And so liabilities begin on the credit side, which is the right side. Okay, sorry, back over here. So notes payable we did, unearned revenue we didn't have last year, but common stock is 10. And so retained earnings is just still empty. So common stock begins at 10. And so that's that beginning balance. And all of these will start at 0. So now we're ready to post. So if you want to pause me and then I will just post really fast. Or if you want to go ahead and post along with me, we're going to go to each transaction. And now sometimes students are like, well, how do you know what side you're supposed to put it on? It's the same side as the journal entry. So letter A is a debit to cash of 40. So I'm just going to go to the cash account. Letter A, the credit was revenue. Transaction B was a debit to accounts receivable. So I'm going to go to the left side of accounts receivable and I'm going to put 20 and the credit was revenue of 20. Transaction C was a debit to cash of 18 and a credit to accounts receivable. So letter C was 18, letter C was 18. It doesn't matter if I put it on the top row or here. It doesn't matter as long as you put it on the correct side. Letter D, debit cash, credit unearned revenue. Letter E was debit unearned revenue, credit revenue. So I am just doing exactly whatever the journal entry says. Debit unearned revenue, put a number on the left side. Credit revenue, put a number on the right side. Letter F is wage expense for 16. And I'm gonna put it over here. Again, it doesn't matter what row, okay? You can put it at the top, you can put it in the middle, you can put it at the bottom, as long as you get it on the correct side. So letter F was wage expense and cash. Letter G is prepaid insurance of 3. This is G. I know I don't remember, sorry. Okay, G was prepaid insurance of 3. And then I'm going to credit cash for 3. And EFGH is prepaid rent of, I think, 9. Oops. And letter H of 9. Make sure that was right. Yep. And letter I was telephone expense on account 250. Oops, I'm putting the wrong one. It was telephone. And I'm going to pay that one later. But I'm going to pay my utility bill right now. I don't know why I behave like this, but okay. And I'm paying it right now. Okay, now I've posted. So posting is tedious. I had to really concentrate while I did that. I was really thinking while I was doing that. So I was making sure I got things on the correct side and making sure that I didn't skip anything. Because if you don't post properly, then you won't balance and then you won't know what's wrong with it. So the next thing I need to do is I need to find my balances. And so some of them are really easy, like supplies. We didn't do anything with it. You can just rewrite the number and double underline it. Okay, it looks like accounts receivable is 2,000, and then you would double underline it. Again, the way I find that is accounts receivable is an asset, so it should have a balance on the debit side. This is the positive side, and this is the negative side, so 20 minus 18. So the 9,000, you can just double underline the 9,000, or you can rewrite it and then double underline it. Same thing here. Double underline. Okay, this one, same thing. Okay, so just double underline it. I'm a little annoyed because I'm having to keep rewriting things. And so like these are all fine. So I can just take each of these numbers because I'm kind of getting lazy right now. And so because I've been making videos for quite a while, you know, you've been watching videos for quite a while. I'm just going to double underline all of them because they're done. They don't have anything else in them. I know that there's a line there and that's why I was rewriting them because it made me feel better, but it's fine. Revenue looks like a total of, now when you look at this number, a lot of you are going to write 70 because you're like 40 and 20 and 10. That is not 10, that is 1. So that one is 61,000. So if you accidentally write 70, then you won't balance later. This one's balance is 0 because the 1,000 and the 1,000 wipe out. And I think that's it except cash. So cash is the hard one. You need a calculator for that one. Okay. And so I'm going to add these up and subtract these because this is the positive side of cash because cash is an asset and ADE increase on the debit side. I know I keep repeating myself. That's on purpose. 3,100, 40,000, 18,000, 1,000, minus 16, minus 3, minus 9, and minus 500. I got 33.6. I'm not positive that's right. I made me a little bit nervous. I'm going to add it again. 3,100, 40,000, 18,000, 1,000, minus 16, minus 3, minus 9, minus 500. Okay, maybe it's right. Okay, 33,600. Now I'll know if it's wrong later because I won't balance. But usually you guys would tell me in class, so everybody would add it up and then we would all confirm that we have it right. So now we have all of our balances in our T accounts. So once you do your journal entries, you post and then you come up with your balances. And then from there, that's when we went on and did financial statements. But now I'm going to teach a new topic to you, and that topic is doing a trial balance. And so a trial balance is not a financial statement. So I'm going to say that again. Our financial statements are income statements, statement of retained earnings, balance sheets, and statement of cash flows. A trial balance is not a financial statement. It is just a check for us. It's an internal document that we can use to make sure our debits and credits equal. So the best way to make sure you're in balance is to prepare a trial balance. It just lists all of your accounts and their balances. So if your trial balance doesn't balance, then you got to look for the difference and see if you can figure out where you messed up. So let's go ahead and let's do a trial balance. Oh, look, our business finally has a name. Worldwide Webster. It's lame. Okay, so what we're going to do is we're going to list all of our accounts and then their balances, whether they're a debit or a credit, and then we're going to total them and see if we equal. So I'm just going to start with the assets and go down, and then accounts payable and common stock and so on. So I'm going to start with cash, and the balance is 33.6. Now, again, I'd like the word debit to be right there and the word credit to be right there, but they're not. Okay. So the next one is supplies, 900. The next one is accounts receivable, 2,000. And all I'm doing is this is going to be an internal check for us. It has a who, what, when. This is called unadjusted because we haven't done adjusting entries yet. We learned those in chapter 4. And we're just checking to make sure our debits and credits equal. After accounts receivables, prepaid rent, 9,000. Then we had 3,000 of prepaid insurance. And then I think after that, we had PPE of 21,000. And then we had accounts payable, notes payable, and unearned revenue. And then in the next column, we had common stock, retained earnings. I'm looking to see if I have enough rows. Revenue, and then we had wage expense. So I'm just listing all of them. Common stock, retained earnings, revenue, wage expense, utility, and telephone. And then we will do totals. And when we do totals, we will be very hopeful that these two numbers will equal. That's kind of what our goal is, okay? Not kind of, it is. That's what our goal is. So we're going to go ahead and go find the balances and the rest of these T accounts, and we're going to put them in the appropriate column. So I have the debit column and the credit column. And so, was that there before? Earlier, I thought I said, I wish it had a balance. Well, now it does. And I wish it had the words there, but now it does. Okay, maybe I'm losing my mind. Okay, so maybe it was just not showing up and now it is. I have no idea. Okay, so accounts payables balance is 250, 15,000, and 0. By the way, if they're 0, you do not have to put them on there. But I did, so I'll just put 0. Common stock is still a credit and it's 10, and retained earnings is 0. And then revenues were 61,000. But ADE are debits, assets, dividends, and expenses. I have no dividends later. 16,000, utilities were 500 and telephone was 250, I think. Utilities were 500, telephone was 250. So I want you to notice that ADE are debits, and then we're going to add them up and we're going to see if this equals. If this equals, then our balance sheet will also equal. This is a check to make sure that when we were posting, we didn't make any mistakes. And when we were doing transactions, we didn't like leave off a debit or credit. So 33,600, 900, 2,000, 9,000, 3,000, 21,000, 16,000, 500, and 250. I got 86,250 for the debits. I'm going to say a little prayer and hope for the best on the other side. I've got 250, 15,000, 10,000, and 61,000, 86,250. All right. So lucky me, it balanced on the first time. When you go to do homework, that's not always the case, okay? So just keep in mind that when you go to do homework, sometimes you're like, oh, why doesn't this thing balance, okay? So 86,250 and 86,250. If it doesn't balance, here's a list of things to kind of help you along. So if it doesn't balance, you can re-add your numbers. Or if you used Excel, make sure you got all of them included, because sometimes like when you do equals sum, you accidentally forget to pick up the first one or the last one or whatever. So re-add your numbers and make sure that you did that right. One time I looked for a mistake for like hours and I just realized I didn't add right, and that was very annoying. Okay. You can look for abnormal accounts. So ADE should be debits. So if you've got a liability and it's over here in the debit side, that's wrong. Okay. So liabilities have to be credits. And so look for ones with abnormal balances, and those are probably wrong. You can go back and just look and make sure, like 900 and then make sure that you wrote 900. It's really easy to write 9,000 instead or 90 instead. That's called a slide error when you drop off a zero or add a zero. One thing you can do is you can take the difference between these two numbers, and maybe the difference between the two numbers is 3,000 exactly. If that's the case, then maybe you just forgot to include that number. Okay. So go back and look for your mistakes. And so trial balances don't find all mistakes. They find mistakes in posting, but like if you just use the wrong account name, like if you did this transaction and you used accounts payable instead of cash, then your cash account's going to be wrong and accounts payable is going to be wrong, but they're going to offset and you're still going to balance. And so trial balances don't find all mistakes, but they will find mistakes in your posting. So that's kind of what this was talking about. Would recording an $800 sale on account as a debit to cash? If it was on account, you should have put it in accounts receivable. Cause the columns of the trial balance to be unequal? And the answer is no. Okay, so it doesn't find all mistakes, but it does find a lot of mistakes. And so it says based on the trial balance on the previous page, but we can all acknowledge that the trial balance is on this page. I apologize. I took out some stuff to make it a little shorter for you. What's the net income? Okay, so we're going to look at this information, and you could build an income statement right now and a statement of retained earnings and a balance sheet and stuff. So to look for the net income, we would use revenue of 61, and then these are our expenses. They look like 16,750. So my revenue is 61,000 minus, what did I say, 16,750? And I defined that, I just added up my three expenses. So 16,750. So my net income is 61,000 minus 16,750, 44,250. Calculate retained earnings. Okay. Beginning retained earnings plus net income minus dividends equals ending retained earnings. So beginning retained earnings is 0. There is no retained earnings, right? It's 0. So I would say 0 plus 44,250 minus dividends are 0. So 44,250. Okay, because there were no dividends. What are total assets? All right, let's add up the assets. These are all assets. So I would just need to add them all up. So my total of my assets are 33,600, 900, 2,000, 9,000, 3,000, and 21,000. 69,500. Again, I added all of those up. What are the total liabilities? There are 3. Now you only want there to be 2, right? Because you don't want unearned revenue to be a liability, but it is. So, but it's 0 anyway, so it doesn't matter. So it looks like 15,250. And total equity is common stock plus retained earnings. Common stock is 10. And retained earnings is from right here. Now, if you use 0 for retained earnings, then you won't balance. But retained earnings is ending retained earnings. So 44,250. So that would be 54,250. Okay, so remember that we do the financial statements in this order. We start with the income statement and we got net income of 44,250. Then we do the statement of retained earnings and we got 44,250 again because we had no beginning and we had no dividends. And then we do the balance sheet. So the balance sheet would show assets equals equals liabilities plus owner's equity. And so assets are 69,500 equals 15,250 plus 54,250 is the accounting equation in balance. I don't know. 15,250 and 54,250, 69,500. Yep, it is in balance. And so I could have done the 3 financial statements. I couldn't do cash flow because I didn't give you enough information. I probably did, but whatever. And I was going to have you do the financials, but I was trying to shorten your notes a little bit. So I just did the computations. So that's it for chapter 3. The chapter 3 homework is posted as well. And I will give you a preview of all of the homework in the overall week preview. So Hope you're well. Hope this video is a little bit shorter. I'm honestly not sure. I just talk until I'm done. So I hope you guys are doing well. Next week will be only one chapter. And so we had to do 2 this week because the chapter 2 and 3 are a little bit shorter. So I hope you're doing well and I'll talk to you later. Thank you.